So week 7, this is the first week of stuff which isn't in the mid-semester, which, mid-semesters are coming, it's that time of year, finally the rain seems to have stopped, fingers crossed. It's starting to become light, it's still light when you come to class. You know that good part of the season is just around the corner, but there is work to be done before we get there. So there are some things that we need to do. I don't know, holding aside the accounting for them, I think most of us as employees, those who are employees in the room, certainly like the benefits of being employees. There are good sides to it. I do this not just because I love to do it, because I do really enjoy to do it, but it also helps put food on the table, which is a really handy thing. So what we're going to be looking at in relation to this is it's not just the sort of just general wages that people get, because that in itself is pretty straightforward to deal with. That's not really that complex an issue. Where it does become a little bit more problematic and where we're going to spend a little bit of time is around these other types of benefits that we get. Not all jobs will have all of these benefits. For sure that most university employees, we don't get any sort of profit shares or bonuses just because we're not a profit-making institution. We make surpluses, which is different. We don't have shares, so I don't get a share package or options in the university because there is no such thing in a university. Well, at least most of the Australian universities anyway. So some things, when we talk about them, I have no personal experience of them. Some of you may well have a personal experience of these particular items. But many of these things, depending on the type of work that you do and the type of conditions and types of things that you have attached to your employment, you may well have. So a lot of the leave conditions will have, a lot of superannuation things that we need to talk about, potentially long service leave. These are things which make the accounting more complex because they're benefits which employees get, but they're not necessarily straightforward as just, well, cash is going out every fortnight or every month, and then we just account for that. So we're going to be looking at those today. To do that, we need to have a look at a liability. And I know we went over liabilities last week, but to the extent that it is looking over these again, it is important, and liabilities are a part of the mid-semester exam. So there is a benefit from looking at this in a slightly different context for what happens in a couple of weeks' time. So we'll look at liability and the benefits and the definitions of them. We'll look at what employee benefits are and where the problematic issues lie in them. And as you've probably already gathered, it's not just the regular cash payments that we get every fortnight or every month. It's those other things which are around the place. That's where a lot of the problem is. And then we'll get into the actual regulation and accounting for some of these things. So, definition of a liability. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So when it comes to employees, that first little section is really important. That idea that you have a present obligation. Because the university knows, I've contracted to the university and it's a continuing contract, it's not for a specified period of time, but it also holds for, if you're on a particular length of contract, it might be a 6-month contract, 12-month contract. If you're looking at sports people who have got designated 2 or 3 year contracts, these sort of things, the organisation knows how much they're likely to get paid over that period of time. The university is very clear. They've got schedules of if you've been here, if you're at this level and this far in, you'll get paid X. So they know next year how much I'm going to get paid. They well and truly understand that. But the idea of a liability, so this is what is recognised on the financial statements, at least from how the framework sees it, is something where there is a present obligation at this point in time. So I'm going to ask you guys a question. So the university, they know how much I'm going to get paid. If I'm here in December, they know how much my pay is going to be in December of this year. If I'm here in June next year, they know how much I'm going to get paid then. Does the university have an obligation to me for my pay in June next year? At the moment? No, none at all. Because what could happen between here and June? I could get fired. Thank you. Yeah, I could get. Thank you. Yeah, no, it's true. I could get fired. I could quit. something bad could happen to me and I'm not in a situation where I can work. There are a whole range of things that can happen between here and June. Christ, there's a whole range of things that could happen between here and tomorrow. That means that I'm not going to be in a position where I'm working and getting paid, potentially not part of the organisation. So just because they know how much I'm going to get paid and my contract covers that period of time, does it mean that they are going to be obliged to pay any of that? So this idea is, in essence, what an organisation is obliged for is work that has been done. So when you're talking about employees, and that's not that dissimilar to pretty much anything else we've looked at with expenses, you're obliged, you're on the hook for when something has been performed for you. So if I'm sitting here and talking to you guys about employee benefits, this is me performing my service, or at least part of my contractual obligations to the university. There are other things I need to do as well. If they don't pay me for doing this now, then there's a liability for them because they owe me for doing this. But they don't owe me for the class I'm going to do in 2 weeks. Actually, not in 2 weeks' time, because that's your exams. So in 4 weeks' time, whenever, for next week's class, for the classes after that, they don't owe me now for those classes because I haven't yet done them. Settlement, which is, so there's a past event that we're dealing with, and is there an outflow of resources? Well, hopefully they're going to pay me. They do, so which is good. But not every workplace, you do hear of situations where organisations do stiff their employees, and that it's not like it doesn't happen. But this idea that there is going to be an outflow, they are going to pay me, and it's for more likely than not, and in this case, it's going to be cash. Obligation is a duty or responsibility, they need to pay me. Past event, I've worked, and an outflow of resources is going to be cash. So to recognise that, this idea of probability, so a liability is recognised in the balance sheet when it is probable that an outflow of resources embodying economic benefits will result from the settlement of a present obligation, and the amount at which that settlement will take place can be measured reliably. That's important again when you're starting to think about it for the exams in a couple of weeks' time, when you're trying to work out provisions versus contingent liabilities versus doing nothing. Is probability an issue there? Is reliability of how much you're dealing with an issue? So as we talked about, I don't know if anyone, some people still do get paid cash in hand. It's, still obviously does happen. It's not as common. Certainly, back in the day, that's how people got paid. Certainly a few jobs, earlier on, like I got paid, especially helping out mates for event type stuff, I got paid cash. And so that is a way some people will get paid. Now, whether or not they're accounting for it properly or just keeping things off the books, I don't know. But it's all these other sort of things which we have part of, for a lot of people have part of their employment contracts. This is where the accounting issues start to arise. So I don't know, think about it, the contracts, and think about your work, and think about the work, and the place that you work. Think about the benefits you get. And obviously you'll get pay, but do you get sick leave provisions? Do you get annual leave? Do you get bonuses for what you do? So I get sick leave and annual leave. I don't get bonuses. I don't get shares or options. I do get long service leave. I do get sabbaticals. So every 3.5 years, we can take 6 months off, which is pretty sweet, fully paid. So if you think about academic life, there are some upsides to it. Superannuation, we should all should get. And if you've been reading papers, you've seen that they've capped the increase. It was going to increase from 9% to 12% as a statutory rate. It has now been capped at 9.5% after a deal got done with the Coalition and the Palmer United Party. Whether or not that's a good or a bad thing, leave up to you. But yeah, it's been held at 9.5% in the near future. Termination payments, hopefully I won't get fired and have to worry about termination payments. But we'll talk about what these are as well. So some benefits should be fairly straightforward. But long service leave, like this is something, so for me, I remember sitting when I started work here, my boss at the time sat me down, we had a chat in his office, and he was like, where do you want to be in 10 years? And I remember thinking, I didn't say it because it probably wouldn't have gone down well, but I remember thinking, I'm probably not going to be here. Lo and behold, 11 years later, I still am here. And I triggered my long service leave last year. I haven't taken any yet, but I have now can take it if I want, which in a way is a bit scary to think I've been here that long that I can actually do that. But that's a situation where I haven't just earned the right to do that in that 10th year. I've earned the right to get long service leave and take it through working for 10 years. So then from an accounting point of view, if that leave gets taken in the 10th year or maybe the 15th year or the 20th or whenever it happens to be taken, it shouldn't just be an expense in that 15th year or in that 10th year or whenever it happens, because you've earned it through working for 10 years or working for 15 years. So then the question is, well, how do you split up that cost or that expected cost in the future across that whole period of time of working? That's not necessarily an easy thing to do, and that's what we're going to look at today in a lot more detail. Share options. We looked at an example in week 1 where companies previously they could give away share options and they didn't have to account for it as an expense at all on the book. So they could basically do it from a profit and loss perspective for free. And people have gone, well, that's not really the case. Like, these things are valuable, you're paying them instead of giving them cash, so we've got to somehow account for them. But then how do you come up with the value of these options? How do you do that in a reliable way? Superannuation. Without giving the game away too much, I'm not going to be able to touch my super for a long, long period of time, and you guys, I'd hazard, looking around the room, probably even longer than me. How do you account for something which we're not going to be able to touch or deal with in 20, 30, 40 years' time? Now, depending on the type of superannuation, it may not be such a concern, but there is a particular type of super which causes massive accounting issues with it, and we're going to have a look at that today as well. And to build into this, and we'll see it when we do the practical example as well, most of the inputs into these determinations are not objective, in the sense that it's not an absolute number that's being used. It is a number based on assumptions on various things happening, and once you start to bring in subjectivity into the equation, that leaves that sort of wriggle room open to play around with it a bit. So we'll look at what these estimates are and how they can impact. So it is important. Well, if you think about employee benefits, every single employee is getting paid a benefit. So there's a huge, we're talking serious amounts of money that have been dealt with. And if we look at Qantas, nearly $4 billion of their 2012-2013 costs were staff costs. So that's about a quarter of their total expenses. So you're talking a reasonable amount of money. And wages will be a big part of that, but we're also dealing with superannuation issues, we're dealing with leave issues, and these are things that we need to take into account and need to figure out what's going on with them. And it's also useful, and we won't look into how this was calculated, but Qantas, at least in 2012-2013, had unrecognised actuarial losses on the defined benefit plan of nearly $350 million. And the important point to recognise in that number is, in that line, is that that is an unrecognised amount. So they've had these losses, and they have not once come through the profit and loss statement. So that's the sum total of their losses over time. So I mean, if you spread that out, I mean that means that Qantas's profit has been arguably overstated by $340 million, $350 million over those previous however many years. Now, if you don't know that this thing exists, you don't build that in. Now, the reason I bring it up is that we're doing some work on defined benefit plans, and of the top 100 companies that we could find, well, not that we could find, the top 100 companies, Qantas was the only one who accounted for it in this particular way when it was unrecognised. That's not to say they're not allowed to do it, they are. So this is nothing incorrect with the standards. But they're the only one who chose to go down this particular path. As to why, we don't know. But that's something that sort of we are having a look at. So we'll talk about what defined benefit plans are in not a few moments time, but a little bit. So AASB 119 on employee benefits. So the things we're looking at are the types of employee benefits, when to recognise, how much to recognise, and something else, how much to recognise. Turn this off. So we're going to look at everything apart from share-based payments. So we're not dealing with shares and option packages in this particular subject. So employee benefits. So there are 4 types. So if you think of all the employee benefits that you could get, we're not talking about the intangible benefits of, a fun place to work and all those sort of things, which are, I dare say, a pretty important part of working. I mean, as much as getting paid a lot of money to do various things, if where you work is not an enjoyable place to work, that can have impacts on you. But what we're talking about is more kind of the financial and potentially some other non-financial things, but still benefits in the sense that it might be housing benefits or offices or various other bits and pieces. So all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of employment. So it's just everything that they could get. And they get broken down, and if you look at how that works, it makes fairly logical sense. So you've got short-term benefits, which are pretty much the benefits in the next 12 months. You've got post-employment benefits, which are things after employment. You've got long-term benefits or other long-term benefits, which are things that you're expected to get while still working, but after 12 months. And you've got termination benefits, which is when, not necessarily when you get fired, because if you get fired, you generally don't get a payout for being fired. It's more sort of voluntary redundancy, retrenchment type situation. So that's more where termination benefits come into play. Right, so short-term employee benefits. Short-term employee benefits are employee benefits other than termination benefits that are expected to be settled wholly before 12 months after the end of the annual reporting period in which the employees rendered the related service. Things we're most used to: wages and salaries, paid annual leave, paid sick leave, profit sharing bonuses, non-other monetary benefits. So, it might be that, I don't know, we used to have this, although we don't get it anymore. That for some people, the university would pay for parking in the parking station at the entertainment centre. So they would pay that parking cost. Given that car park's about to be closed down, obviously that doesn't happen anymore. But so those are sort of things, and you can think of other situations and other sort of benefits that you could get in that way. So how we do this is when that employee has rendered service during that period. So it's me standing up and talking to you guys, doing all the other various sort of teaching functions. I'm performing my service. The entity shall recognise the undiscounted amount of short-term employee benefits. So we don't have to discount it because it's over a fairly short period of time. And we recognise it as a liability if you've got things which haven't yet been paid. And so that's that classic when you get to the end of the financial year and maybe you've worked 3 days of the pay period and that's been accrued. That's the liability that we're talking about. You recognise that amount as an expense, so it would generally be debit wages expense, unless you can build that wages cost into something else. And that's where it articulates with something like AASB 102 on inventory or AASB 116 on property, plant and equipment. So that's that linkage. Right, so employee Bill has completed 1 week of work for TED Enterprises. Bill's weekly wage is $1,000. So to the extent that you recognise the expense, so this is the incurrence of the expense, you recognise the $1,000 and you recognise the payable for the fact that hasn't been paid. And once it's been paid, you get rid of the payable or the liability and you credit cash $1,000. That all basically merges down into debit wages expense, credit cash. That's first year accounting. That's something that you guys should all be comfortable with. Where it gets a little bit trickier is when we start dealing with absences. Now I'm going to have a few questions for you guys for this. So an entity shall recognise the expected cost of short-term employee benefits in the form of paid absences. So what we're talking about there is sick leave, annual leave, potentially parental leave, all those sort of things. Now how you deal with it depends on whether or not that leave is accumulating or non-accumulating. So I'm going to find out because not many people have this. So if you've got a phone on contract or even some other, mainly it's on contract stuff, so I pay $80 a month for my phone, and I think a little bit is paying for the handset as well, but $80 a month and I get a gig of data each month. Luckily, because I think my month just rolled over today, I was getting pretty close to going over the gig. If I don't use if I have unused data, so if I only use up 900 meg in this particular month, I don't get to roll that 100 meg that I haven't used, I don't get to roll that forward. So that is a non-accumulating setup. Do any of you guys have a plan or like a mobile plan where you actually get to roll unused credit forward? Like, is it limited to, is it 1 month? Same sort of, okay. So it's not a complete, like it's not perfect in the sense you can't just sort of not use it and have this massive sort of build up of available credit. So you get to roll a little bit forward, which is really handy. That's what we mean by accumulating. Whatever you don't use this particular month, you get to roll forward and then use it next month. And in a pure accumulating system, that would just keep rolling forward and keep building. Now, some of you may be aware of what your leave provisions are. So for me, my sick leave and my annual leave are accumulating. So my sick leave, if I don't take sick leave in, like all my sick leave in a particular year, I get to roll that forward into next year and I get to keep rolling it forward. So at this point in time, I think I've got about 1,000 hours of sick leave accrued. Some silly amount of hours because I haven't really taken too much of it. My annual leave accrues as well. And so I get 4 weeks of annual leave a year. If I don't use all that 4 weeks, I roll that forward. Now, generally speaking, we have to take most of it because we get, and if any of you guys are working in firms and are aware of how this works, generally you'll get told you've got to take your annual leave. Like, you know, this period of time, especially around Christmas, we're shutting down and you're taking leave for that. We're not quite so bad with that. So generally, we get to roll it forward. We're meant to be capped out at 12 weeks. So you could basically accumulate, I'm wrong with that, 8 weeks. So you could accumulate 2 years worth of annual leave, kind of rolling forward without taking any, until they say, well, you've taken up too much, and you'll start getting nasty emails to say, take it, or you'll lose it. So, I mean, you can't just keep doing it indefinitely. I'm pretty sure, and this is really nice when it happens. So there's obviously things like maternity leave, which you get access to, but it doesn't accumulate. So it's not like if you're not pregnant this year, you can sort of take all that leave and then roll it forward to next year and then roll it forward. Like that obviously kind of wouldn't work. I got 4 weeks or 6 weeks. So when Evie was born, I think I got 4 weeks of parental leave as the not non-dependent, Evie's a dependent, non-main carer person, whatever the definition is. That's not that technical. But again, I don't get to kind of keep accruing that over each year that I don't have a kid, so that when Evie was born, I could take a year off or something like that. So those are non-accumulating benefits. So those are pretty much you either use it that year or you just lose the thing. And the accounting for it is very different. So accumulating, you deal with it as the employees render their service. So as I work, there'll be a small accrual for my sick leave and annual leave through all that period of time. For parental leave, they don't have to accrue anything. They don't have to worry about anything at all until I apply for and take parental leave. And then at that point, they have to deal with it. So there is a small difference with how it works out. With accumulating, it's even then different between the types of leave that you get. So an entity shall measure the expected cost of accumulating paid absences as the additional amount that the entity expects to pay as a result of the unused entitlement that has accumulated at the end of the reporting period. So the critical thing there, and thinking back to what a liability is this idea of an outflow of resources. So what we're trying to figure out is how much that we're dealing with. And the main difference between the leave types that you have is whether something for accumulating leave is whether or not it vests or doesn't. So my sick leave, my annual leave is vesting. And what that means is if I get fired, or if I just leave for whatever reason, and if I have a balance, an annual leave balance sitting there, they have to pay me that full amount out. So if there's 3 weeks of annual leave sitting there, they've got to pay me 3 weeks of pay, even if I've left. My sick leave doesn't work like that. So I've got, as I mentioned, something like 1,000 hours of sick leave. And if you work that through, I mean, even if it was 50-hour weeks, which it isn't, 35-hour weeks, but 50-hour weeks is what, 20 weeks? So take it down. It's probably about 6 months of sick leave I've got. So that's a reasonable amount. So I hope I don't ever have to use it, but if I do, I could be sick for 6 months and still keep getting paid all the way through. But my sick leave is non-vesting. So what that basically means is I can only get a payment in relation to my sick leave if I'm sick. If I leave, or if I'm fired, or for whatever reason I'm not part of the UTS anymore, they're not going to pay me 1,000 hours of leave. They're not going to sort of work out what I would have been paid for that and say, give me a big lump sum of 6 months worth of salary. That leave just disappears. So then what it becomes is a measurement issue. Because they know there's an obligation. Like no one is 100% healthy all the time. And if you probably fairly too young for most of this, but if and when you have kids at preschool or at daycare, you get sick all the time. It's a pain in the ass. Like they go, someone else is sick, especially during winter, they pick it up, they pass it on to you, you're sick, you finally get them back to school, they pick up something else. And that's been pretty much my life for the last 6 weeks. Where was I going with that? I can't remember. Sick, yeah, getting sick. They've got to work out how much they think I'm going to get sick and take sick leave. And how much and take sick leave before I leave the organisation. Now think about trying to figure out that calculation. So you're trying to figure out, how much sick leave you've got accrued, when you're likely going to leave the organisation, and how much of that sick leave you're likely to take between now and then. And they've got to do that for every employee, and obviously that's where actuaries get involved, and there are ways to do that. That's not what we're going to be worried about. We're going to assume we have those inputs and we can work it out from there, but that's the idea that we're trying to get at. Right. To liven the room up a bit, I'm actually going to need 3 volunteers because it just works a little bit better if we have people actually doing this rather than talking about employees A, B, and C. So I just need 3 people. I'm going to pick volunteers if I don't get volunteers, but I just need 3 people to come down here just for 2 minutes. Sure. Yeah, come on down. I need 2 more. And a quick game's a good game. Thank you. You just love getting involved, don't you?
Yeah, that's me.
Yeah, come on down. All right. So who wants to be employee A? So what's your name?
Joe.
Joe. I should call you actually. So Joe is employee A. Amar is employee B, and Nick is employee C. So each of them have worked for this particular company they've worked over the course of the year, and at the end of this year, you guys have been really healthy. You haven't taken a day of sick leave. So you've got this sick leave, you've got 2 weeks of sick leave accrued. 2 weeks is a lot of sick leave per year, but anyway. You've got 2 weeks of sick leave accrued and you get paid $1,000 a week. So potentially if you were to take that sick leave, you'd get you'd be paid $2,000 when you took it. Joe is accumulating and investing. Amar is accumulating but not vesting, and Nick is non-accumulating, so it's use it or lose it. So I know the answer sort of on the next page. So the idea with Joe here is you're going to get this payment, whatever. So if you kind of I'll just get you to step forward, so into the next year. So he steps forward in the next year. He then walks away from the organisation and decides he's found a better job somewhere else, and you want to move on. If your sick leave is accumulating investing, which is pretty unusual, the organisation will actually give you $2,000 in relation to that sick leave. Yeah. So it doesn't matter if he takes it or if he doesn't take it. There is an obligation for $2,000 in relation to that leave. Amar, if I can get you to step forward. Amar's slightly in a different situation because her leave is not vesting. So if you leave, you don't get any of that. So if you leave straight away, you get 0. But the thing is, you're going to stay on, and they expect you to actually stay on and be sick for 4 days. So they expect when you take it, there's going to be a payout in relation to your sick leave of $800. Now, poor old Nick down the end has been really healthy. He's had his 2 weeks accrued. But as soon as he steps forward into that next year, that 2 weeks just gets wiped out. So he doesn't get any benefit from the fact he was really healthy this year. So before we get into the accounting for it, and just one last thing, why would as far as I've seen, most employers use accumulating sick leave? Why do you reckon that is? This isn't an accounting thing, this is just a business, like just general.
They have to recruit somebody else in the place.
What's that?
They have to recruit somebody else. When someone is sick very long, you have to get somebody else in the company.
Yeah, so you have to potentially get someone else. But why?
Industry standards, modern awards.
Maybe it could be a modern award thing, so maybe just they have to. But even from even if it wasn't that, why do you think employers would prefer this?
Incentive not to take it.
Yeah.
So at least they know when they do get sick, they could potentially have X amount of weeks.
Yeah, that would probably be the case, because think about the different setup. So Nick, if you haven't used your 2 weeks, it just disappears. So what's your incentive to do?
My incentive is just to take off because there's no point of being here getting a new job. One of a few.
Is to get sick. Yeah, just find the Fridays or the Mondays before a public holiday and be sick. That would be, there's an incentive there to chuck a sickie, which Australians supposedly seem to do a lot. Although, on the other hand, we're also supposedly quite hardworking.
No.
No?
Like, everybody goes to Australia to relax.
In Europe,
Yes.
they shut the shop for like 3 hours in the middle of the day.
No, they were much more than here.
I was going to say, is anyone Greek around? No? Before and that's what I was going to say, and that's why yours isn't accumulating. But anyway, won't disparage nationalities here. But Joe, but that's also why it's not really done in the way in Joe's setup, because we're not building up sick leave and say you can take it. I mean, if it was that, then they would build in how much they're going to potentially pay you and then lower probably other effects. So they'd probably pay you a little bit less on other lines, which is also this idea with superannuation. If that amount increases, it's not that suddenly you're getting paid and then the amount of super increases on top. They'll just sort of squeeze what you're getting. Your salary increases will happen over the foreseeable future. So generally that's why you see what Amara is getting is the idea behind it, because you get to roll it forward, so you don't get sickies chucked, but also you don't necessarily have to pay out cash for it. You're just paying out cash for what is that for when you're actually sick. So it sort of protects the employee, but it also kind of protects the business from having to stump up too much money for it. So I think this is non-accounting, but from a business idea, it makes sense. So when it comes to the numbers, we'll turn around. So Joe, we actually recognise a liability, and it probably would actually be a provision for leave rather than leave payable. We'd recognise a provision for Joe of $2,000 because whenever it happens, you're going to get $2,000 in relation to that sick leave.
Yeah.
For Ma, we'd recognise $800 because we expect her to be sick for 4 days. So of that $2,000, you're not going to get all that too. You're only going to get that $800. That's what we expect to happen. May not eventuate. You may get really sick and then you'd get that $2,000, or you may not get sick at all. But we've kind of put $800 against you. And poor old Nick down the end there, we don't have to do anything because nothing got rolled over. So thank you guys.
Isn't it overestimating the employee B?
Yeah, there is an estimation
No, I mean,
over it.
you will pay anyway. Let's say you have yearly salary 400,000. It doesn't matter if the person takes sick leave or not.
They're not
This is like extra.
No,
Why would you do that?
no. For Amar, she's not getting paid. Like if she leaves the company,
No, but it's still in the accounting. Why?
because you're expecting it's like warranty provisions. You
You
don't.
have to lower the expense for the salary then to make sense.
No, you're still, what you're doing, this is part of the overall kind of salary package. So you're still recording an expense for this, the normal wages. This is sort of that additional, okay, we're recognising that there is a potential cost in relation to your sick leave, and this is what we're reflecting.
You know what I mean? Because you're overestimating
Well, if you've overestimated, so if they don't actually take sick leave, then you're...
I mean, it doesn't matter if they take or not. You will pay per year 400,000 and either the person is at work or the person is sick. It doesn't
Okay,
matter.
it doesn't matter. They're still getting paid. Yeah, no, but that's actually really important. So I think what you're getting at is it doesn't matter if they're being paid from the kind of the leave bucket or from the wages bucket. They're still getting paid.
In the same money.
Yeah, that's really important because we were forced. It was suggested that we take annual leave last year because. If you've got to build up, what happens is, and this is where kind of, it's not necessarily an overall there's a part of it which is an overall financial reporting issue. Part of it is just then where the budgetary money comes from. So there were two reasons why it happened. Why we were all suggested that we take leave, and it was strongly put to us that it would be good that we did, even if we weren't actually going on leave. So we all had to take a week. And the reason it happens is if you take a week of leave, if you don't take that annual leave, that's been built up as a liability. You've got a whole bunch of your staff to take annual leave, it drops your liability. So we were basically told to do this just before the financial year end, to drop that liability on the balance sheet. But the second reason comes at your point, which is it doesn't. If you're taking it as leave or as salary, it doesn't matter. You're still getting paid. You're still getting paid that much in your pocket. That is true. But I know from our point of view. So from me, when I took that leave, I was still getting leave.
But I don't know, leave you get extra pay. So that's
No, there wasn't any leave loadings or anything like that. It didn't change. If I get paid annual leave, if I get paid salary, it doesn't change it.
Okay.
What it did change though, and this is from an internal budgetary perspective, is if I get paid salary, that is coming from my department's budget. If I'm getting paid leave, that's getting paid from the university's, like from a slightly different budget. So if you're trying to manage, like at least from our point of view, if you're managing the internal budgets,
yeah, but
to
then
get it-
you have to lower the yearly expenses because this is what they do with the budgets.
yeah, I think we've come to some slight agreement, possibly, maybe.
Yeah, but you have to, if you do a leave expense, then you have to lower the expense for the salary in the same amount to actually transfer your life to the.
You only record salary
Different
once
ones.
you pay it though. You don't record like
No, you can
400,000
accrue.
stuff.
Yeah, no. So what you'll
You
get,
can
yeah,
lower expense,
yeah.
you have to
No,
lower
you've already
expenses
when
for the
no,
salary.
not for the okay. No, I'll say during this year, at the end of this, like over the course of this year. So let's just say we're talking about this year. Over the course of this year, you will record the salary expense based on what's paid. What you're talking about is when I actually get sick and take it next year, there won't be a salary expense. So we're lowering the salary expense when you take it.
No, this year should not be extra expense for
Okay.
leave expense. Because it will overestimate the year, like the expenses.
Okay. How about, because we're kind of having a conversation just the two of us right at the moment. So why don't we just sort of hold, there's going to be plenty of time at the end of today. So why don't we just hold that? We can come back to, this is a reasonably short lecture. So profit sharing and bonus plans. I can't speak to this from a personal point of view. Certainly a lot of financial institutions, they get paid quite good bonuses, but universities don't. Imagine what happened if we got paid bonuses based on failure rates. Either way. So the incentive really isn't there for bonus setups to happen. The important point with this is, again, you've got a present obligation in relation to them, you've got a reliable estimate, but this is the key point of this slide. Paragraph 23, these are not distributions of profit. These are, even if they're talked about as profit sharing, these are expenses, and they're very explicit in the standard that is what they are. Because if you think about it as a profit share, that's almost like you're distributing profits, it's almost like a dividend, it's not an expense item. So they're very clear that is not what it is. It is absolutely an expense. So that's an important part of profit sharing and bonus plans. Ooh, that must be the end of short-term benefits. What I wanted to talk to you about, and this, probably, not probably, this belies things that I'm interested in. But it relates to employee benefits, and there are some angles which are, I suppose, particular to this particular industry, which may or may not be of interest to you, but there are also broader picture things which are useful for this. So what I wanted to talk to you about was actually the Brisbane Broncos, because they are the one team in the NRL which is a publicly listed company. So they have accounts available for them. You can go and have a look at them. You can go and see what assets they've got in their books, see what liabilities. And what you see, the players are not assets of the business, and we've talked about that before, but so you don't see them listed on there. Some of you, so just a little bit of background around them. So Nationwide News Proprietary Limited, which is involved obviously with News Corp, own nearly 70% of this particular company. So if you're buying shares in the Broncos, you are very much a minority shareholder in this particular organisation. What was interesting, and this is what happens when you spend too much time looking at annual reports. There were really recently a focus of a salary cap investigation. It turns out there was nothing in it, although if you read the papers, it seemed to be a bit dubious what was going on, but nonetheless, there was no salary cap problem, so to speak. Now, the salary cap is a really convoluted system. If you've ever spent any time looking at what it is, there's not just you can pay X amount to your players, you can pay X amount to your top 25 players, and then you can pay a smaller amount to players outside that squad. You pay a certain amount as another sort of group of, another amount of money to you're under 20 players, you can pay for medical insurance and various other things. There's a whole bunch of different buckets which get included in the salary cap. So to give you a sense, the sort of headline figure is for the top 25 players, there is a salary cap of $5.5 million for them. But then there's all these other payments that could be made, and the NRL sort of estimate that those should be about $7 million per year. And if you add them all up, that's around about right. But this is where being a listed company and having available reports is interesting. Because if you look at note 26.2, they actually sitting behind the accounts. They've got what's called player contract commitments. I just want to read out that little bit there, which is commitments for the payment of player contracts in existence at the reporting date, but not recognized as liabilities. So think about that from an information perspective. These are not services which are being rendered. So these players haven't, this amount, this annual report was at the start of this year, so December 31st of 2013. So they are saying that this $7.7 million is how much they expect to pay to players during the calendar year 2014. The salary cap is around about $7 million. So again, I'm not saying there's anything wrong with this, but on face value, it looks a bit funny. Now, I know there's ways in which things can get front-end loaded and back-end loaded, and there can be sort of various things which go on. But from an information perspective, think about this, is that these amounts are not recognized. So if you were to just open the liability, like open up the balance sheet, you will not see that on a liability, on the present obligations that they have. However, I know people cut and run with contracts, and obviously Sonny Bill was a really famous example of that. But they expect to pay $7.7 million over the next 12 months. That, from an informational point of view, would be quite useful to know. So you can see that they have estimated what they expect to pay. This note has been audited by the accountants. So to the extent that those guys have looked at it and are comfortable with what this information is, they've done that as well. So that means there might be information in notes which is still useful for you to know about what's going to happen in future amounts, but not necessarily in the financial statements themselves. When we get to leases in a few weeks' time, this same idea of something which is recognized versus something which is disclosed as commitments becomes a much bigger issue. And when we're talking economic significance, it's massive. So yes, rugby league may, personally I'm a sort of rugby union person, but rugby league may not necessarily be your kettle of fish, but this idea of information and where it's housed, whether it's in the financials or within the notes of the financials, is actually quite a useful thing to understand. I just found it interesting because that seemed much larger than what the salary cap could be. And when a couple of weeks ago that this breach idea came about, to me it didn't actually seem that strange. Now, it turns out it was okay. Still a bit dubious what happened there, but it doesn't seem to be related to these particular numbers. Anyway.
Yeah. Oh, yeah.
Post-employment benefits. It seems weird that, and I've used the ordering in which they've done in the standards, but that they go short-term to post-employment without long-term first. So post-employment benefits, for most of us, at least me at this organisation, that's going to pretty much be solely superannuation that we're dealing with. Depending on the type of employment you do work in, though, that could be a whole range of things. So politicians, for example, are big ones for, they talk about them as perks and luxuries and whatnot of office after the fact. So they'll get, free travel, free airline travel domestically and a few sort of international trips a year. They'll get office and staff paid for sort of every year till whenever. And yes, it may seem like a lot, but then on the other hand, whichever spectrum they come from, I think it's a pretty tough job being a politician, and I certainly wouldn't want to be one, and I think they probably do earn it. So they do get offices and they do get these various things. So that's the benefits that we're trying to deal with. So the recognition and measurement of these things, so post-employment benefit plans are classified as either defined contribution or defined benefit plans. So what we're thinking about, we're just focusing on superannuation. We're not going to run any numbers with this because, as you're about to see, some of them get really convoluted, how you actually come up with a number, and then how you account for it could be a whole range of different things. What I want to get across at this point is just what the differences between these plans are. So on one hand, what we have are defined contribution plans. So we'll talk about them first, and then we're going to have defined benefit plans. Now, quick show of hands for those that work. How many of you guys have having money put into superannuation right at the moment? Okay. How many of you are aware whether or not you have a defined benefit? Or you don't necessarily have to tell us what it is, but how many are aware if you're in a defined benefit or defined contribution style plan? Oh, you guys are aware? Do you want?
No, I'm pretty sure I am.
You're pretty sure. You're pretty sure you know. You don't have to.
Yeah, sure.
Okay. So when we're talking the differences in these plans, what we're not talking about is, have you selected the growth option, or have you selected the sustainable plan or the balanced option, or that's not what we're talking about, because all of those types of things are choices in a defined contribution plan setup. So there's actually a much bigger overarching difference between defined contribution and defined benefit. Something like 83% of all superannuation money in Australia at the moment is in defined contribution style plans. So the odds are that the plans that you guys are in are defined contribution style plans. It's very rare nowadays to see defined benefit style plans. They're generally legacy companies, so sort of bigger, older companies, although most of these bigger companies are phasing them out. The public sector is big for this sort of stuff. Universities definitely use them. I know because I'm in mainly in a defined benefit plan myself. And we're going to talk about what these differences are and why companies, and you're hopefully going to see quite clearly why companies have shifted towards using defined contribution plan style plans. Because if you go back into the early 1980s, something like 80% of people were in defined benefit style plans, and we've shifted almost completely the opposite way now. So how we deal with it is as a liability after deducting any amount paid, and as an expense. So pretty much the same terminology that we saw for just short-term plans, short-term benefits. So defined contribution plans. A defined contribution plan, so the entity's legal or constructive obligation. So remember, when we're dealing with liabilities, what we're worried about is the obligation that this company has, or the entity has. So that obligation is limited to the amount that it agrees to contribute to the fund. Thus, the amount of the post-employment benefits received by the employee is determined by the amount of contributions paid by an entity, together with investment returns arising from the contributions. In consequence, actuarial risk and investment risk fall on the employee. So the risk is on you. The risk is not with the employer. And that's basically why employers like this, because as long as they pay their 9% or whatever it's been agreed with the employee, and some companies pay more than 9%, but as long as they've paid that amount, they're okay.
It's a lot better than the sheet from last week.
Does it look like? I don't. I'm not gonna ask that question. Okay. So what we have is we've got you, and then the fund that it's been invested into. So what we're dealing with here is a defined contribution plan. So in a defined contribution plan, you'll get paid, you'll do work, and let's just say whether it be an hourly, whether that's $100 an hour, $100 a day, $100 a week, whatever it is, you get paid a certain amount of money. Now what's required at the moment, and we're not dealing with whether or not, let's just say it's on top of, but the idea is they will pay, the company will put in a certain amount into your superannuation fund. That's the general gist of it. Now, the defined bit is the contribution. So this is defined so that's defined on your salary. So however much you're earning, if you start earning more, then 9% will obviously be a bigger number of a bigger number, so more will get put in. Then what will happen is these guys will go off and invest it. And obviously you get a little bit of choice about how they do that. You can choose, sort of growth and balance and whatnot. But they'll go off and do the things that they need to do to make you money, and hopefully they won't lose it. And some superannuation funds do, and that may be their own fault. It may just be what happened 5 or 6 years ago with the GFC and everyone got hammered. For whatever reason, they'll invest it and they'll do well or do badly. Then at the end, and I'm just going to simplify it, let's just say a lump sum comes out, and it doesn't have to be like that, but you will get a certain amount of money at the end of that when you retire, and you can get access to your super. And how much you get is going to be based on what was put in, how well they did it, and what fees they took out of it, and then you get what the outcome of that is. So the risk is on you. If they do a good job, happy days. You can start, traveling overseas every other week. If they do a bad job, well, you're kind of stuffed. But importantly, from the company, and we're dealing with the accounting for this particular organisation, as long as they put in that 9% or whatever they've agreed to put into your super, that's where their risk, that's where their obligation starts and finishes. And not everybody does this. If you've been keeping an eye on what was going on with Nathan Tinkler, there were issues that he wasn't paying superannuation to his employees. And so this does happen where they don't actually pay these amounts. But the defined bit is this. So it's limited to the amount that it agrees to contribute. So that's that 9% that's going in. So the amount that you get at the end is based on that 9%, so the contributions paid plus the investment returns from the fund. If they've done well, happy days. If they haven't, that's, well, bad luck. A defined benefit plan is different. So defined benefit plan is where the entity's obligation, so we're talking about the organisation that's paying you your wages and then putting money into superannuation. The entity's obligation is to provide the agreed benefits to current and former employees, and the actuarial risk and investment risk fall on the entity. So in this case, the risk is not on you, the risk is on the employer. And so you can already see why employers have started moving away from, well, not just started, they've moved away from this, because as long as they're putting in their 9%, that's it, they're done. In this, they put in their 9% and then they've got to be aware if there's a shortfall. And Qantas is an example of that. So under its defined benefit scheme, more than 13,000 former and present Qantas workers are guaranteed fixed payouts when they retire, despite the collapse in returns from the financial markets. So let's have a look at how this works and find, where are we? So let's clean up some of this. Get rid of that. And let's take a different color. Okay. So this still, in a sense, you still work for the same company, and you can have people working side by side. They could have the same, that slightly different to those ads, same age, same salary, different sort of superannuation outcome. That's looking at industry versus sort of non-industry super funds, so slightly different. But there are certainly people that I know that are on the same, like on a similar level at me here, that they may have chosen to go down a non-defined benefit route. So they'll still be getting paid the same amount. They'll still have the same amount of superannuation go into their fund. But then in one of those, the university is obliged to deal with any shortfall. One of them, they're not. So in this case, you're still working for $100. The company's still putting in 9%. And I suppose in a sense that is still defined on your salary. The fund goes off and invests it, hopefully does a good job. Then what I will get out at the end, so whatever lump, let's just say it's a lump sum, is a function of a whole range of things, including years worked, but importantly, salary at the end. So I know, and I've gone and have a look at the formula for this. So whatever the average of my final 3-year salary is, assuming I stay in the industry, they work out, that's a major part of the calculation to work out what the payment is. Doesn't matter if the superannuation fund's done a terrible job of investing, that payment is arguably what I'm meant to get. So the risk isn't so much on me, the risk is on the organisation here to put in this 9% plus sort of make up any shortfall. So they're an obligation, they've got to put in their 9%, which they've got to do anyway. But then they've got this kind of other thing which is sitting in the background, which is if suddenly they don't have enough money in the fund, they've got to be able to put money in if need be. Now think about that calculation for a second. The fund has assets. And that's, you know, everything it's gone and invested in. That should be relatively easy to calculate. So the fund will go, okay, we've got this much in equity and this much in fixed income and various other things that they've got. Try to get the valuation of these at the end of that financial year. Depending on the type of asset class they've invested in, it shouldn't be that difficult to get that number. So they go off and get that number. They then compare it to the liabilities they have, which is sort of payments and expected payments to all the various employees and retirees. And some of those payments, you know, I'm not going to be able to get access to this for years. And so they've got to estimate what they think my payment's going to be. So they've got to figure out what they think my estimated salary is going to be. They think we've got to, you know, how long, you know, whether I'm going to make it to that far. They've got to do that for a whole range of employees. That's where the actuaries come in. That's a difficult calculation. If I suppose assets are larger than liabilities, the fund has enough, there's nothing they need to worry about. But if the assets are less than the liabilities, then it's basically saying there's not enough here to pay all these payments out that we expect to happen in the future. Now, then the accounting gets really tricky because just because there's a shortfall now doesn't mean it's not going to recover in the near term. So they're allowed to actually, there are different ways they're allowed to account for that. And one of those, as we mentioned at the top, was booking these as unrecognized actuarial losses, and that's what we saw Qantas do. So you can actually have these losses, but you're allowed to basically, you can record them all as a loss, you can record them in equity, you can not record them at all, you can do other stuff with them. It's quite a mixed bag of what you can do. We're not going to look at how we calculate that. The thing we want you to just be aware of is if it's a defined benefit plan, the risk is on you. If it's a defined contribution plan, the risk is on the company. That's the big thing to take away from this.
So with the calculations?
No, not for this. I mean, to do a defined contribution plan is straightforward. It's just, you know, however much cash is going in, as long as you're doing that. Whatever the liability is how much you haven't put in for the 9%. To do a defined benefit plan, no, like that's really complex. So.
Do you know what's happened if they did they terminate and fire them or?
I mean, they're going to come up with a provision, an estimated provision. Like they're going to come up with an estimated liability amount, and then it gets really
Just pay them, or do you know, like, you know, what's happened if they don't finish before, like when they only by retirement, but before, like.
Oh, if they retire, if they.
If they decide to leave your company, what's happened with that?
Well, actually, that's a good point. So if I leave, and I can only speak about what. So as far as I'm aware, and don't necessarily hold me to this, if I leave, if I move to a different university, I can stay within UniSuper. I can kind of move that along to somewhere else. If I leave UniSuper, they'll just take whatever they've calculated as my balance at this point in time, and that balance is based on my salary at this point and how long I've worked. They'll just take that amount and put it into an accumulation fund. Now, it is a bit geared towards the longer you've been here because of the way the calculations work, and it's a lot too convoluted to go through here and now. It very much ramps up towards the end. So if you've been there for 30 or 40 years, it starts to look really, like it gets really promising because there's a loading factor which they multiply the number of years, but they also add a loading factor in. And that loading factor starts to increase once you've gone about 20 or 25 years at the place. So I mean, they would just say, they'd just take whatever my balance is and just dump it in an accumulation, like a defined contribution style plan. yeah, just roll that in and say that's your balance, just kind of, and it'll start to accumulate as a normal plan from there. So I mean, in a sense, it's what your appetite for risk is, and you may not necessarily get the choice. Like for me, my superannuation balance all the way through the GFC would just kept going up because it wasn't based on the market. So whilst everyone was saying, seeing their talking about superannuation balances being cut in half, because mine was just based on my salary and the number of years that I worked, it just kept going. That said, when times are good, I won't get such an uplift from it. So it's just, yeah, it's your level of risk aversion and the choice, and even if you have that choice. So defined contribution plan, you do it as services rendered. So it's the same idea as wages. It's almost like you're getting paid a wage, but it's just going somewhere different. Defined contribution plan, you still have the same payment that's being made to your super, but in addition to that, and that's that extra bit I was talking about, you need to determine the entity's constructive obligation. Now to do that, you need to have a look at the plan assets. So we talked about the investments. You need to have a look at the liabilities of the fund. So basically how much the pension payments are going to be, or the superannuation payments are going to be. Get the difference between them and then figure out what you do with that difference. And there's a whole range of different things that could be done, and it's, yeah, not for the here and now. So other long-term benefits. So these are things, post-employment benefit, so just other things other than short-term post-employment and termination. Long-term paid absences, so things like long service leave, which we'll get to, jubilee or other long service benefits, long-term disability benefits, profit sharing and bonuses, and deferred remuneration. We're going to look at a particular type. We're going to look at long service leave and actually walk through an example of one. The amount recognised as a liability for other long-term employee benefits shall be the net total of the following amounts: the present value of the defined benefit obligation, unless any fair value of plan assets. And for long service leave, there's not going to be a fair value of plan assets. So all we're trying to work out is the present value of that obligation. That obligation is defined based on salary, because if you get long service leave, the value of your long service leave is based on the salary that you're getting paid. So we're trying to figure out what that value is and get the present value of it. There are no plan assets. We recognise it as an expense, and we include it as an asset, unless we include it as an asset. Cool. So we're going to have a look at the question. Too big. Okay. How we'll work through this is we'll look at the information from it, and then we'll actually map out what's going on, and then we'll come through and work through the numbers. So we've got long service leave. We've got Bob. Don't know why I kept. Actually, when I was in London, I was working with a Bob. Bob has been working at his current place of employment for 8 years. He is entitled to 12 weeks of long service leave when he has worked for 15 years, although he is eligible for a pro rata payout once he's worked to 12. Actually, I should be marking some of this up. So the information that we need, where is it? Comment. Oh, it's not there. I opened it in the wrong style. Anyway, that's a bugger. I'll write it somewhere else. So the information that we need is, we need to know how long he's worked for. I think this is going to work. Sweet. So he's worked for 8 years, and he gets 12 weeks of leave when he's worked for 15 years. So if we left it at that, so my long service leave works much like that. So once I hit 10 years, I got access to a certain amount of leave. But if I didn't make it to 10 years, if I made it to 9 years and 6 months, and you walk away, you don't get any of that. Some will have this, from your point of view, some will have a pro rata payment, some won't. So the idea is if you get to 15 years and there's no sort of pro rata payout before that, then you're worried about what happens at 15 years. If there is a pro rata payout, what we're interested is, so he's eligible for a pro rata payout at 12 years. So what we'll do is, let's map this out quickly. Don't need this anymore. Nope. Okay. So what we've got is a situation where this is when we started work, we've come a whole bunch of years, and we're now here. So at time 15, that's when he's earned 100% of his long service leave. He's only at time 8, so he's earned just over half of it. But we're also told that there is a pro rata payout, like he can get a pro rata payout at this point. So this is, I suppose, when an obligation happens at time 12. So if he was to get to this point in time and then sort of step, a day further on, he would get something. It wouldn't be 100%, but he would still get something at time 12. So what we're interested in is the benefit that he gets here. So we're interested in the benefit that he could get at this point in time, and that's going to be based on things like his salary. I'll just do it underneath. What we're worried about is what he's actually going to get paid at that point in time. So we're interested with his salary then, because the amount of leave he could take and the value of it is based on his leave at this point in time, not at this point in time. We're interested in knowing how much leave he actually gets to take, because he won't get paid, he won't get a year's worth of leave. He'll get a certain number of months or a certain number of weeks. And we also need to take into account how much he has earned. So at 15 years, once he's worked for 15 years, he's earned 100%. Anytime before that, he's earned less than 100%. So the idea is we come out, we get a benefit figure. So that is the defined benefit obligation that we're interested in. We'll then take that figure, because we've got to get the present value of it, and we're going to get a present value of that figure. So this is happening at time 12, but we want to know what today's value of that figure is, of how much he has earned. And there is one more thing we need to do after we do that. So we're here, we roll forward and figure out what the benefit is. Oops. We figure out what the benefit is, we then roll it back to get the present value and figure out what the present value is of that benefit, which is what the requirement is in the standard. And as I mentioned, there's one more thing, which is, I'm going to get you guys, it may be fairly, depending on how much you've read of it, it may be fairly self-evident, but let's just say I'm Bob. So I've worked for 8 years. In 4 years' time, we're going to work out what my salary is going to be in 4 years' time if I get there. We're going to figure out what the obligation is to the company in 4 years' time based on how much I've worked so far. We're going to take that number and go, well, that's a future amount. We've got to roll it back to time 8. And that tells us the present value of that amount if I get there. What is something that we haven't taken into account at this point? So we figured out how much the benefit is in 4 years' time. We've worked out this number. We haven't done the calculations yet, but we figured out what this benefit figure is. We then present valued that benefit and figured out what the present value of it is. What's something we need to consider?
Probability of payout.
Yeah, probability of payout. So what could happen between now and time 12 that's going to affect that? Yeah, I could quit. So if I quit in time 11, what's my payout? It's 0, because I haven't made that 12-year period. If I make it to 11 years and 6 months, I get 0 payout. So we've got to work out the probability that I'm still going to, if I'm Bob, if I'm still going to be there in 4 years' time. Because if I'm not there in 4 years' time, the payout's going to be 0. So it's almost like there's a certain percentage chance of a 0 payout, and there's a certain percentage chance of some payout. And we're trying to figure out what that is. So we need to take into account the probability of that present value. And so that's what we're going to be looking at. Bring it up. So we've got this idea of what his salary growth rate is. We've got a discount rate because we're going to have to present value stuff. We'll come back to the opening balance. And we've got a 60% probability that he's going to be employed in 4 years' time. Plus, we've got a current salary. Okay, as we go through this, I'm going to ask you guys questions about whether or not you think the inputs are subjective or objective, in the sense that are they estimates of things or forecasts of things, or are they an absolute given number? So the first thing we've got to do is actually to get the benefit in the future is to figure out what he's going to be paid in the future, because your leave is based on your pay at the time. So projected salary is important. So the company has an obligation to Bob once he's worked for 12 years. So we've got from his current salary of 83,119, we've multiplied it by the growth rate and the four-year period, and we've ended up with the projected salary of 104,936. So we've got 3 inputs into that. We've got his current salary, we've got the growth rate of 6%, and we've got the years till payout of 4 years. Which of those are objective and which are subjective? So is 83,000 a hard number? The 83,000? What he's being paid right now? Yeah, so 83, they know that's what he's getting paid right here and now. The 6% growth.
Subjective.
Yeah, it's subjective. That's something that they've kind of come up with a valuation to figure out what they think his salary is going to be. And the 4 years until he gets his payout, yeah, it's objective. So we've already included one level of estimation into this, which is that 6% figure. We then take that 104,936, and we're actually going to figure out what the benefit actually is, because that's just his salary. And good luck to you if you've got a long service leave where after you've got it, you get a full year's salary, but it's not common. The accumulated long service leave benefit is the proportion of the years Bob has worked. So this first section here is figuring out how much he's earned. And that is based on how many years he has worked now, not what happens in time 12. This is the 8 years that he's currently worked over 15 years, which is how much he needs to get to 100%. The 12 over 52 is he gets 12 weeks, where is it? The number of weeks leave he's entitled to, which is 12 weeks, which is a given. If you're using weeks, we're happy if you use just 52. Don't take it up to 52 point whatever it needs to be. So if it's weeks, just use 52. If it's months, just use 12. There is no subjectivity in any of those numbers. We know he's worked for 8 years. We know he needs 15 years to get a payment. We know that he gets 12 weeks leave, and we know there are 52 weeks in the year. So we end up with 12,915 as the accumulated long service leave benefit. We then need to roll that back, and we use the present value calculation. So it's the 12,915 divided by 1.07 to the 4. The 1.07, is that a subjective or objective number? Yeah, it's subjective. This is just a discount rate that the firm has come up, or the company's come up with. They could have chosen 6%. They could have chosen 10%. I think when I've seen research on discount rates, companies generally choose. Generally, 10 or 12% just seems to be the most commonly used rates. Now, why that is, I don't know. But those sort of ballpark rates seem to be the ones that you generally see. So now we have a present value, 9853, and we take that 9853, that represents the present value of that long service leave entitlement. But there's only a 60% chance that he'll be eligible for that payout. That means there's a 40% chance that he will leave before 4 years, in which case there is a 40% chance of a 0 payout. So it's almost like you've got 60% times 9853 plus 40% times 0, which is obviously 0, gives you a value at the end of the year for long service leave liability, or provision for long service leave, of 5,912. So that's at the end of the year. That's not the expense for the year. We started the year with a leave balance of 2,000. We end the year with a leave balance of 5,912. The difference is what we're interested in, and that difference is taken to an expense because we know nothing different, and we increase the liability by 3,012, and we're done. So we've got the difference, which is the difference between this and the opening balance. We debit expense because we haven't been told anything different to debit it to, and we credit liability because the liability itself is growing. And that is how we work out the long service leave calculations. Questions, if any? Cool. Just hopefully that made some sense.
I just don't understand why 12,915 is the value of 12 years.
Which one here?
On step 4.
This one is the value at 12 years. Because what we've done, because why it's 12 and not 15, or
Why is 12? I thought it must be 8.
oh no. So what we've done, and I'll come back to. So what we've done to get that 1215 is basically work out that. So we've worked out, we've gone, okay, what is this future salary, and then worked out how much is earned, and that gives you that 12,915. So that's the value at time 12. What we're interested in is what is that value at time 8. So that 12,915, because we're looking at his future salary at that point. So we're kind of rolling it forward, figuring out what his salary will be in 4 years' time, and then working it out based on that. Yeah. Nick, you look quizzical.
I'll be honest, I originally thought we'd find out the amount by just minusing 104 grand by 83 grand.
No. No. That's just a difference in his salary rates. Like, we're actually working out what the payment, like the actual obligation that they have to pay in relation to his portion of leave.
No worries.
It's one of those ones where, yes, you can be shown it, and it's important that we do go through it, but it's one where it's actually running through it and calculating it and playing around with it is an important thing. Termination benefits. Hopefully don't have these cropping up anytime soon. So termination benefits are employee benefits provided in exchange for the termination of an employee's employment as a result of either an entity's decision to terminate an employee's employment before the normal retirement date. So this is from last year. But generally when you see companies talk about cutting costs or restructuring, it's generally getting rid of people. Just seems to be the language that gets used. So this idea of a restructure is, I suppose, terminating, it's not just, that's not the only example of terminating employees' employment before the normal retirement date, but it is one. Or an employee's decision to accept an offer of benefits in exchange for the termination of employment. So sometimes there will be redundancy payments paid or voluntary redundancy offered. So a couple of years ago, Sydney were offering staff redundancy payments. So they were trying to there was a blowout in costs and various things, and they were actually offering people, will you take redundancy? And here's an offer for that. Certainly I had friends, not at Sydney Uni, but when the GFC was going on, who were out working, and it was trouble out there at that point in time, and people were being offered packages to basically quit and to leave. Most people were being offered 3-month redundancy packages, although a friend of mine did get a 6-month package, which wasn't too bad. He then buggered off and travelled the world for 18 months. Seemed like he had a really good time, was sort of keeping an eye on what was going on. Did take some time to get a job when he got back in the country, but he seems to be doing all right for himself now. So this idea of a voluntary offer, that's also when we're talking about it. It's not, I'm getting paid my sick leave or my annual leave amounts which are due, which are part of something else at the end. An entity shall recognise liability and expense for termination benefits at the earlier of the following dates. Either when you can't withdraw the offer, so I suppose you then are obliged to make good on it, or if you're recognising cost in relation to a restructuring that is within the scope of 137. So if you look at 137, it talks about what is classified as, when you can recognise cost for a restructuring. And one of the elements they talk about is, have you publicly made a commitment to doing so? So Telstra's commitment to say we are basically getting rid of people and we're restructuring and doing things would be indicative of they're pretty serious about this. So you could start to build those in. But I would have a look at the restructuring section in 137 if you're interested. Measurement. You should measure the benefits on initial recognition and measure and recognise subsequent changes in accordance with the nature of the employee benefit. And after we finish this slide, I do want to talk a little bit about the exam because I did so in the day lecture and it's only fair that we talk about it as well here. So we covered what the definition of liability is. We linked the treatment of employee benefits with the liability definition, and we looked at has the event occurred, and if so, how much? So what are the key issues for accounting for employee benefits? So that's what we did.